Right, well, I don't need to do the introducing bit, but I do want to say that if you fall asleep during this, you don't have to worry because we are live recording the Merryn Talks Money podcast, so you'll be able to listen to it over and over and over again at your leisure later. Right, we're going to start. We've only got 25 minutes, so we're going to dive right in. Sebastian, thank you for being on my live recording of my podcast.
Pleasure, Merryn.
We're going to start with something that I read in one of your newsletters, OK? Markets are never constant. They change and evolve like the weather. Trends can sustain for months and years, perhaps even a decade, but not forever. Now, we're in the middle, I think you would agree, of a massive regime change for markets, from a world of low interest rates, low inflation, globalization, peace, low labor costs, cheap energy, all these wonderful things, to a period when all that has changed. Is that fair? Is that how you're looking at it?
It's very fair, and it means that it's going to make investing a lot tougher over the next 3 or 4 years, maybe the next decade, than it has been for the last decade. The last decade, you almost needed to just do very little, buy and hold growth stocks. They were re-rated over a long period of time. There are very good companies in the UK and the US where you've seen steady growth, not spectacular growth, not like the tech companies that we were hearing about earlier, but just good, solid engineers, businesses that are growing 5, 10, 15% per annum. And they've been re-rated. They were re-rated hugely over the last decade. They went from 15 times earnings to 30 times earnings before COVID, even before COVID. We had the COVID blowout. They went to 50 times earnings. They're back now at about 30 times earnings. We're on a long journey back to that 15 times earnings where we were when interest rates were still zero back in 2012. Interest rates are, now between 4 and 5%. If you look back at valuations when interest rates were 4 or 5% prior to the financial crisis, valuations were on those mid-teens multiples for good quality stocks. So I just think we have a long journey ahead. There's going to be more volatility, and that's what you need to be patient about in terms of from perspective of investing for private wealth, which is effectively what I'm doing. Yeah, what you're doing is attempting to preserve our capital, right? Yes. So, but you've been positioned for inflation for quite a long time. So yes. Possibly too long. Yeah. Possibly too long. Merryn. Thank you for that. So you came into this latest bout of inflation ready for it? Yes, pretty ready. I mean, I think that we were aware that there were huge concerns that interest rates were far too low. And that inflation was unlikely to remain stable. And the remarkable thing is that come 2 years ago, 2.5 years ago, 10-year yields got to as low as 0.5%. That sort of started a journey whereby the dominoes sort of effectively fell. And then we saw inflation remain stickier due to those post-COVID issues. And that sort of continued. And then obviously a year ago, we had the war with Ukraine, which I think was a massive wake-up. Anybody who thought that inflation was going to be transitory, anybody thought that inflation was going to return to 2%, which markets were forecasting at that particular point in time, I think that was when everyone realised that interest rates needed to go up quickly. And inflation was likely to be around, and here we are, a year later, UK inflation at 10.4%. It's not going away. But there are still people who think it is going away. There are still people who believe that once the impulse of higher energy prices and the supply problems of COVID disappear, we will go back to 2-3% inflation. Interest rates will fall, and the old normal, or what we perceive as the old normal, will return. And then the panel before us will be happy because technology stocks will soar again. The everything bubble will return. Yeah. I don't want to say it's Panglossian, but that's very optimistic. Of course, it's possible, but I think it's unlikely for all of the reasons that you gave in the original question. You've got deglobalization happening. You've got the power of labour, which is higher than it's been for many years, if not decades. And I think one of the things that I've always said about the expectation for higher inflation is wages. And it's always wages that you've got to look at, ultimately. There's noise of commodity prices, there's the noise of the oil price, there's the noise of food prices. But ultimately, the thing that sustains inflation over longer periods of time is wages. And we have actually been seeing wages rising materially. We've seen, obviously, strikes in the UK, but generally wage pressure. As services have come back, post the pandemic, particularly last year, we've seen a material amount of wage pressure. Now, maybe that won't be sustained.
But we can track it, can't we, by watching union membership? And one of the most interesting dynamics of the whole thing, I remember being told a couple of years ago that wage inflation could not be sustained because the unions weren't powerful enough. And thinking, you've got that the wrong way around. Union power follows inflation. Inflation doesn't follow union power. And we can see union membership rising and rising and rising, which may not be a bad thing, by the way.
No, not at all. But I think wages are key. Capital's had it, had a fantastic time for the last 2 decades, 3 decades, you could say. It's Labour's turn, and Labour is having its turn, certainly at the moment. We'll have to see how that lasts. But if that continues, then I would be more cautious about the view that you gave earlier about, rates coming back down, inflation coming back down to normal. I think we're just in a world where things will be more volatile. Inflation will be more volatile. Inflation will come down. There's something called the base effect. Rishi Sunak knows about the base effect. He's not stupid. So that's why he's forecast inflation is likely to halve this year. Maybe it will, maybe it won't.
I don't think he's forecasting. He was saying that he would bring it down.
Yes.
Yes.
So single-handedly. But there is a base effect. And so unless something dramatic happens from a geopolitical perspective and the oil price doesn't go up to $150 or something, then inflation is likely to be falling this year. The question isn't whether it falls. The question is where it stops, and ultimately whether there's a sort of second wave out next year and the year beyond. And that will be the surprise to the investors who are saying things are going to come back down to where they were pre-COVID.
Yeah, so it feels like an environment where you would expect volatility at best.
Yeah.
Yeah. OK, so rates rising.
Yeah.
Rates are not going to come back down to zero. This isn't going to happen. And in an environment where rates have basically been falling for a couple of decades plus, and then they start 4 decades, and they start to rise, things start to break.
Yeah.
Right? And we're beginning to see things break in the world of investment trusts. We're beginning to see some problems related to rising interest rates. We're seeing various bank problems, etc. What's going to break next? Where do you see the breaks coming?
I asked a colleague about this earlier. The usual suspects are European banks. They're usually, obviously we've had Credit Suisse, but I suspect it will continue to be within the banking sector, or within sort of shadow banking type companies, perhaps that we've never heard of, like Greensill.
Yeah.
But those sort of issues will I suspect, these dominoes will continue to fall. One of the things that I think there are parallels with what we're seeing at the moment from a stock market point of view with 2000 to 2003 and 2007 to 2009. So the financial crisis and the dot-com bubble busting. Both of those times, the S&P fell about 50%. And there, people say, well, is this a great financial crisis? No, it's not. The banking system is a lot better capitalised, particularly the larger banks are much better capitalised than they were when Lehman went bust. So there are differences, but there are similarities. And we've seen, a tech bust, effectively. And we've seen issues in the banking sector. And this time, they're related, whereas in 2000, the banking sector was fine. In 2000 and 2009, the tech sector was actually not too bad. Now we've actually effectively got them converging. So I think we need to think about the merging of those two bear markets and think that's probably what we're facing this time around.
Something significantly worse than we've seen.
Well, not necessarily worse, but probably, I think you need to be open-minded about how it's going to play out. But I think
when we say be open-minded, it means we don't know how it's going to play out.
Yes. No, we don't know how it's going to play out.
But any clues.
But I suspect that there will be more accidents ahead because interest rates are still being tightened. The ECB raised rates by 50 basis points last week in the face of SVB. So clearly, the focus of central bankers is still on inflation, as it should be, looking at the UK today.
OK. All right. One of the things that might break, of course, would be the UK housing market.
Your favourite topic.
My favourite. We've been talking about that for a long time.
About
one day when rates rise enough,
yeah,
that will break.
Yeah. Well, there is, talking about domino effects, there is the effect, which I know you've spoken about on your podcast, I think last week, about fixed rate mortgages and the fact that these fixed rate mortgages are coming off gradually. We're not having the immediate impact of the 1990s downturn where interest rates went up from 7.5% to 15% within a space of a couple of years, and it was immediately very painful for people with mortgages. This time round, there's a slower effect of those interest rates effectively coming off, the 2-year rates falling off and people obviously stepping up and having to take a 4% rate, for example, rather than a 2% rate. Yeah. So I think your UK property bear market, long loved, may take a little bit longer to come through.
It'll be slow.
But I certainly think that, I mean, looking at the house builders, the share prices of house builders, which halved last year, that's telling you that you're looking at a pretty hard land. It's one of the reasons why we don't invest in house builders. That sort of thing can happen, and it can happen very quickly, and perhaps when you least expect it. So we will see on the UK house building front. Okay. After my prognostications in the past, I'm going to stay firm on that one. And we don't invest there, so we don't invest in banks, we don't invest in house builders. So it's not actually something which will affect our portfolios particularly.
Okay, well, let's talk about then where we can hide. Because in almost every other crisis in my career, anyway, there has been somewhere obvious, well, not necessarily immediately obvious, but somewhere you can hide, some area that's cheap, something that hasn't been caught up in the previous mania. And this time around, it's quite hard to see that thing.
It is incredibly hard to see that. And we have been talking about this in our investment reports for a number of years, in that we realised that when the debt bubble, when the bond bubble burst, the equity bubble will burst at the same time. And so, whereas in 2008 you could hide in fixed income, get out of the equity market, move into fixed income, move into dollars, you're fine. You were fine. In fact, you could actually make money in 2008 within that environment. In 2001, 2002, 2003, which when I started the Treasury Fund, when I started Troy, then there were some UK value stocks which were well capitalised, things like pub companies, well capitalised, good generally good cash flows, good dividends. They've either been taken private or they've geared up a lot in the falling interest rate environment. So there aren't certainly the obvious places to hide within the equity market. Clearly, with bonds, it's tricky. I think short-dated bonds are fine, sort of 1-2 years. We put a lot of money during the now infamous mini-budget in September and October, when rates spiked to over 4.5% in the UK. That was a wonderful opportunity to sort of just lock in 2-year money. But you're right, there aren't very obvious places to hide. The dollar was good last year. That really helped us last year. This year, I think the dollar's a harder one to call. Generally speaking, when there are risk-off markets, and if we're right about other accidents happening, then the dollar should do well within that. But I suppose I'd be surprised if we saw quite the sort of melt-up in the dollar or melt-down in sort of sterling that we saw back in September of last year. So that there aren't very obvious places. I suppose the one that you'll probably want me to mention is gold.
I do want you to mention that. I was going to wait till the end, but you just, dived right in on that.
Has not been in a bubble.
Yeah.
Did its job in 2020 during the pandemic for us, when everything was melting down. Did its job for us last February during the invasion of Ukraine, and it was flat last year. And everybody looks at the dollar price, Merryn. They don't look at prices in other currencies. We don't hedge our gold. So in sterling, gold was up 10% last year. It did its job for us within the portfolio. It's made a new high in sterling last week. Was it early this week? Definitely last week, during the Credit Suisse debacle. So I think that that still may yet do its job. It's certainly feeling that way. It's feeling as if it's not a bad place to be in an environment where inflation is high, where negative real rates are likely to stay in place. You are not going to see a situation where central banks are going to be able to put interest rates up well above the rate of inflation, which is what positive real rates are.
Because more things will break.
Because a lot more things will break. I mean, I think that was the real wake-up call of the LDI situation. That was the moment where people realised, policymakers realised, we cannot put rates up to 5% or 6% in the UK. Too many things will break. And so rates are probably going to stay higher for longer as a result. And there'll be some drift in terms of policy on inflation targeting. We've seen that with Haldane's article in the FT. We've seen it with Howard Davis of NatWest talking about, thinks we should allow the inflation target from the Bank of England just to drift out maybe 3 years or 4 years, allow them to have a bit more time. that's slippage effectively
or
within the
move
inflation
the 2%
targeting.
to 3%, etc. No one can remember why it was 2%.
Or move to a range from 2 to 4.
Yeah.
Whatever. And that is effectively debasement, and that's a good environment for gold. So I think gold will have a role to play.
And personal assets, for example, holds what in gold at the moment? It used to be kind of 10, 11%. Okay, so the percent of portfolio in gold hasn't actually gone up.
No, it hasn't gone up materially. No, it's been about 10 or 11% for a while. We wouldn't have it go up to about 15 or 20%. I think what's really important with holding gold and having a role within the portfolio is you want to have enough to make a difference. There's no point in having 1 or 2%. It's just not going to move the needle. But you also don't want to have too much where the tail wags the dog. Effectively, it's affecting the NAV too much. You want to place your full bet there. But I think it has a role to play in terms of its defensibility, and you've seen it time and time again. Now three episodes in the last 3 years where it's kicked in, and it's actually kicked in very nicely at a time when things have been pretty febrile, and there were a lot of losses out there for elsewhere within portfolios and other portfolios. Yeah.
And how do you hold the gold? This gold equity is to a degree.
In personal assets, we hold it through an allocated account at JP Morgan, just like a bank account. And that's about 10%. And then we have 1.5–2% in a company called Franco-Nevada, which is a gold streaming and royalty business. We haven't got any direct mining exposure. I'm scarred from my previous gold mining investment experiences. The scars are on my back. So I like the idea of streaming because effectively they're far more in control of their own destiny in terms of the fact they've got hundreds of investments around the world that are continuing to, rather like an investment trust, really a diversified portfolio of royalties coming in, week out. And if one mine doesn't work, it doesn't really matter. Whereas if you're a miner, you'll tend to have only 4 or 5 mines. If one goes wrong, then production issues can be a real problem. So Franco-Nevada's been a core holding for about 5 or 6 years, and it's done very well for us.
Okay. I'm quite like to ask you about Bitcoin.
You can ask me about Bitcoin.
Okay, I'm going to ask you about Bitcoin. Is that another hedge against inflation?
I don't think so.
I mean, I think we know what I think.
Yeah, but no, I think crypto just, for me, goes into the too hard bucket. I think it's been found out a little bit. I was very interested to hear Niall Ferguson's comment about his view on crypto and the fact that crypto had been sort of effectively corrupted.
Yes.
We've never held it. I've never held it. I think gold has actually proven itself over the last year or 2 or 3 during a period where Bitcoin's been very highly volatile. And I think that sort of volatility is the definition of, people don't know how to value something. And it's about the most volatile thing that you can own. So clearly people don't really know how to value it.
This conversation, by the way, everybody, was in my last podcast with Niall Ferguson. We discussed this. Yeah. Okay, but let's move on from that. I'm interested in you saying that when I was talking about there being somewhere to hide, somewhere that wasn't caught up in the everything bubble, and you said no, previous times there have been good value stocks in the UK. A lot of my podcast guests say exactly that now. There is a place to hide, and it is the UK, which is cheap on any measure you could look at, and the value ratio between the UK and the US, for example, is that it's one of the widest it's ever been. And not only that, but these are good, high-quality companies operating internationally with good, high dividend yields. And I think you and I both agree that a good dividend yield is one of the greatest hedges you can get against inflation. So why on earth would an investor like you not be pouring into the UK market?
We're definitely looking at the UK market. In fact, I went to visit the headquarters of a UK company in Slough this morning. So we're definitely looking at UK companies. I would say, Merryn, I'd say you're half right in that I'm not quite... I think you're comparing chalk and cheese a little bit in terms of comparing the US with the UK. If you scrape below the surface a little bit, the businesses within the UK, if you look at the FTSE, there are a large number of very large cap companies that are highly cyclical. We've got a very large percentage in oils. We've got mining. We've got utilities, with large telcos exposure in Vodafone, BT. You've got a very large exposure to banks. You've got house builders. It is not like the US. And yes, there is a valuation differential, and I think there are some things to blame for that in terms of Brexit and other issues that you've discussed in the past. And definitely, investors, particularly in the UK, have been selling down in the UK. We can see that with the flows in unit trusts over the last 5 or 6 years. Wealth managers have been reducing their exposure to the UK stock market. One I happen to know has reduced from 30% of their portfolio down to about 3% of their portfolio, specifically in UK stocks. So you might say, well, there's nobody left to sell.
That is exactly what I was going to say. That if all the big domestic pension funds and all the big balance funds have shifted, which they have now, shifted their holding in UK equities down from 30, 40, in some cases 50%, to a maximum, in most cases, of 3 or 4%, they're done with the selling. It's over.
Yeah.
So that may mark a bottom for the UK.
My one reservation is that all of those sectors that I mentioned, probably with the exception of sort of pharmaceuticals, a lot of those sectors are very cyclical. They did really well last year because we were in a cyclical upturn. If I'm right, and I suspect we're going into a hard landing, a more traditional hard landing than the ones we've had in the past as well. So by that I mean more traditional than the COVID recession, more traditional than perhaps the financial crisis recession, more like the recessions we used to have in the sort of early 90s that are sort of slightly more prolonged, central banks trying to tighten to get inflation down, slightly old school. Then those cyclical companies, like the miners, like the oils, like the banks, probably going to struggle. So they're going to really struggle with earnings, I suspect. So you may be right, but not yet. The other thing is looking at the kinds of companies...
Often right, but not yet.
Yeah.
That's kind of standard.
Yeah. But I think that in terms of some companies that I mean, my largest holding is Unilever.
Yeah.
Unilever is definitely on a discount to the likes of Procter & Gamble, Nestlé, its peers, which we also hold, but not to the same extent. I think there is a little bit of a gap. It's not massive, but I think there is a little bit of a gap between those better quality blue chips within the UK and their international peers. I think that is a gap that has to narrow, and where we have been adding there. So I think that's my half-right bit.
There is a reason why lots of companies are thinking about moving their headquarters to America, and we know exactly why it is, just so they can get a higher share price, right?
Yeah, absolutely.
I interrupted you. Sorry.
No. I mean, I do think that the UK market has got a problem. I mean, they couldn't get Arm back. They've lost some great companies over the years, like Cadbury's, which we were a holder of. There was no replacement for Cadbury's. It's now gone to Mondelez in the US. So I think that the sad thing is we have lost some great companies in the UK, and they haven't been replaced. And that is something which has been discussed ad nauseam for the last 5 or 6 years. And I'm sure you've written about it in your articles, but. There doesn't seem to be a resolution to that. And the concern is that where we've got things like good companies like Ferguson, used to be called Wolseley in the UK, a large FTSE 100 company moving to the US. So I think that there is, I mean, it's not an easy decision. I saw that BAT was suggested by one of the shareholders that the BAT should do the same. It's got a very big US business. It hasn't got a UK business. Yeah. So there is some logic to BAT moving to the US, and tobacco companies have slightly higher ratings in the US than they do in the UK. So we'll see whether they do. It's not an easy thing to do. It's not actually an easy thing just to get I worked at a company where they were getting a NASDAQ listing. They had a UK listing, but they wanted a NASDAQ listing for exactly the reason that you said. And I remember it was bureaucratically really tough. So you've got to be absolutely sure you're making the right decision. You've got to really think
your share price is going to double.
Yeah.
Let's talk briefly, we haven't got much time left, sorry, about the rest of the portfolio. How much of it is in equities at the moment? And
low 20%. So it's basically the lowest it's been for about 15 years. Okay. Even lower than it was in the financial crisis. Partly coming back to the point that you said that there aren't obvious places to hide within this equity market. If there were, then we'd have a higher proportion in equities. But for exactly that reason, we're worried about that continued, not only multiple contraction this year, but also the fact that there's more earnings risk. And interest rate costs keep going up for companies. Companies have taken on, frankly, public companies have taken on too much debt. Debt levels have pretty much doubled over the last year in a lot of companies we've seen. Companies that were comfortable with 1 times net debt to EBITDA are suddenly comfortable with 2. Companies that were comfortable with 2 are comfortable with 4. And increased tax and increased interest costs mean that the earnings, the top line might be fine, but actually the bottom line, the earnings are not going to be as good. So that's why because of those lack of places to hide, that's why we're very conservatively positioned at the moment, with the idea that probably within a year's time we'll be much more, hopefully, positively positioned. We're right.
Positive. We have only got a few seconds left, so let me challenge you before we end. Give me one piece of good news.
I think that sometime in the next 18 months is going to be a very good time to buy the equity market. You've just got to be patient.
How will we know?
How will we know? I think just keep an eye on valuations. I think valuations are going to... That's what I look at. I look at things like the CAPE. I look at things like the Q ratio. I look at the bottom-up stock picking, our bottom-up stock picking our stocks, and look at their valuations on a day-by-day basis. And that's what informs me as to whether I'm going to make those longer-term returns. So it'll be valuations which are the key.
All right, I'm going to call you every week for the next 18 months until you tell me it's time.
OK.
All right. Sebastian, thank you very much.
Pleasure. I look forward to it.